Hi guys. Um, thanks for tuning in to our webinar. I'm Keith. I'm the co-founder of RealVantage. I hope everyone is safe and well. Joining me today is my co-founder Mao. Mao.
Hello everyone. I hope everyone's well and safe. Because of the situation and lockdown, we'll be reaching out to you more frequently through webinars. We hope you will find it useful and insightful in making your real estate investment decisions. We have planned for a series of webinars to help our investors understand various aspects to the real estate business and to provide market updates, overviews on how things are doing in these turbulent times. Keith, back to you.
Okay, so for today, we'll be walking you through the fundamentals of real estate co-investments, its attributes, things that investors should be looking out for. With technology, this concept of co-investing in capital-intensive assets such as real estate has gained a lot of traction. We'll highlight some of the reasons behind it. All right, okay, let's get started. Now, today we'll be covering 4 parts. I will start by explaining the concept of real estate co-investment. Next, Mao will come in and you'll highlight the growth in this industry and the value proposition to investors. Next, I will highlight some important factors to consider when you choose an online real estate platform. And we end off with Q&A. Just a bit on logistics. There's a panel to your right where you can post your questions. We'll take them at the end of the session. Okay, let's start. All right. The concept of co-investment is simply the pooling of capital together to invest. Well, given the capital-intensive nature of real estate, investors and managers are finding it mutually beneficial to work together to finance certain transactions, usually single properties or large assets. So investors collaborate and share a part of the profits generated from the real estate investments. There are several characteristics to take note in co-investment. Number 1, the ownership of the asset is shared. And usually this is through a form of a vehicle, or we call a single purpose vehicle. Next, typically all investors would have a common objective when they pool their funds together. This is usually to maximize returns over an agreed period of time, right? Next is there is usually a set of ground rules that they follow. Someone is designated to be the decision maker, to steer the investment or to make some key decisions, right? Okay, next slide, please. Okay, when you think about it, the co-investment concept is not new. It's actually a pretty proven and tested and employed quite regularly. To the left, you see the private equity real estate funds. Well, these are essentially large institutions, such as pension funds, insurance companies, family offices. They co-invest in real estate projects, and they do it typically through a real estate fund. So they pool their capital together and they put it with a fund manager, right? But on the other side of the spectrum, on a personal level, actually, many folks actually come together to co-invest in properties. Okay, among friends, among family members, they pool their capital. Together. Right. But as you can see, the larger institutions do it in a more structured manner, while on the individual basis, it's largely informal. Right? Now, with technology, we are trying to create some structure and efficiency around this, right? So co-investing through an online platform is to bring that institutional level of co-investing right down to the retail level, right? Next slide, please. Okay, so you might ask, how has technology made real estate co-investing different? Well, firstly, as we know, the use of technology to improve efficiency in investment management is pretty obvious, right? Traditional ways of things can now be done much quicker, from onboarding investors, the selection of assets, the execution of legal documents, and the performance tracking of investments. All these functions now can be done online. For the investors, they have, firstly, a much wider choice of investments that they can choose from, and they can customize to their needs, right? On the deal front as well, there's also a greater level of disclosure on the project and on the information. And in terms of investment tracking, this has also really enhanced with technology. With online dashboards, you can zoom down into the particular deal itself, how well it's performing. You can zoom up and look at your entire portfolio at a glance, right? But most significantly, with technology, the aggregation of investors is now made much easier. Like through online networks, we bring like-minded people together, and this goes beyond the traditional circle of friends and family. So, what does it mean for you? With a wider pool of investors, this brings greater access to better deals, more sophisticated deals, and more importantly, higher risk-adjusted returns. We'll talk about this a bit more later on. Next slide, please. Okay, this is a very common question we get. So what is the difference between crowdfunding and co-investment? And what's the difference between traditional fund management and co-investment, right? Well, crowdfunding, simply put, is the practice of funding a project or venture by raising small amounts of money from large number of people, typically through the internet. Right? Obviously, there's some similarities, but also there are some major distinctions, right? Well, let me try to highlight some of the differences. First, crowdfunding is used quite loosely and used for a wide range of projects, from charitable causes, raising funds for an event, and also for investments. But typically for crowdfunding investment platforms, the platform usually plays the role of an organizer, an arranger, right? They connect people with the funds to the project. So they act like an agent, and they match investors to the project sponsors, right? For example, you might heard of peer-to-peer platforms where they provide SME loans. So they match the investors to the borrowers of the loan, and they take a cut in between, and usually they're out of picture. But for us, real estate is an asset that needs a lot of management. So we don't think it's quite befitting to use the word crowdfunding, because once you invest in an asset, you need to look after it over the investment period until you divest, right? So there's quite a bit of, there's a wider role on behalf of the platform. The platform has to take has to play a bigger role in this, right? So on the other side of it is the traditional fund management. Yes, we are pretty close to the traditional fund management side. But what's the difference? Now, in traditional fund management, after the funds has been raised, it's usually left to the discretion of the fund manager to decide how he wants to deploy the funds. Well, certain funds obviously have certain mandates. Quite clearly, they invest in certain sectors, right? But the point is here, the discretion typically lies with the fund manager, and the investors are very, very passive in that sense. They don't have much say over how the asset goes, right? So for us, in co-investment projects, investors have full oversight of what they want to invest in, and whether the deal itself fits their risk profile, right? And whether the investment period fits their investment horizon, right? So these are a few things that allows you to customize. A co-investment concept allows you to customize how you want your deal to be, right? Okay, next slide, please. Okay, now I pass it on to my partner, Mao. He will touch upon the crowdfunding industry, or rather in the co-investment industry. Mao?
So in short, for the content outline, right? So for strong growth, this section, we're going to discuss about the strong growth and the value proposition of co-investment platforms in other parts of the world. So this growth, we see that it's driven by several factors, and we'll discuss these factors. In our opinion, we see that the greatest driver would be the value proposition that this investment class would bring the investors. All right, next slide, please. So from Ernst & Young statistics and reporting on the market, The global crowdfunding platforms are doing about 84 billion USD and are forecasted to reach 114 billion in 2021. So this is a compounded annual growth rate of 17%. Now, real estate co-investments is a specialized subset of the crowdfunding category, and it has recorded 18.5% compounded annual growth. Now, the number of real estate co-investment platforms worldwide has also increased steadily over the years, as can be seen in the graph below. Next slide, please. Now, so let's get more color into some of these existing platforms in the States. Here we have some of the leading platforms, Cadre, CrowdStreet, Fundrise, and Realty Mogul. Now, deals completed through their platform has grown to in a range of 2 to 6 billion US dollars. Investor count, investor traction has also grown to approximately 200,000 for the larger platforms and tens of thousands for the smaller ones. Now, these companies have been around for 4 to 6 years, and they have achieved a strong following within a short span of time. Now, clearly, this demonstrates the acceptance of co-investment platforms by the investors. Right. Also, looking from the investment track record, right? This their track record has been at north of 10% IRR. Next slide, please. So there are several factors driving the growth, right? And we see that investors are generally now more and more receptive in investing online. So regulators are also receptive in adapting regulations to innovation. This fuels industry growth. Now, through digital marketing channels such as LinkedIn and Facebook, digital platforms are also able to be reaching out and easily onboarding more users. Next, automated processes also leads to lower costs in serving investors. So this allows platforms to be able to help a larger number of investors with smaller check sizes at scale. And this is as opposed to the traditional fund management where it serves smaller number of institutional investors with larger check sizes. So these above are some of the structural drivers that drives the growth. Next slide. Next set. But we find that this underserved segment, right, is probably the growth is most probably fueled by real estate co-investment platforms serving and bringing a good value proposition to this underserved segment in the market. And we'll elaborate more of this in the next slides. So, you may ask yourself, what are choices out there for individual investors who want to invest in real estate? And typically, they get exposure through buying REITs from the open market, right? The other way is through direct investing. And what this means to us, most of the time is to buy an asset, usually a house or a condominium unit, right? Usually in the residential segment, and we rent it out. Mostly, we stick to local investments. But at times, some investors may be able to purchase assets overseas. So personally, I've got investment properties, single-family homes in the United States myself, and we purchase them for rental income. Some of us may be more adventurous and buy, let's say, a unit trust into real estate. But typically, there is a limited choice to investing in real estate. On the other hand, for institutional investors like sovereign funds, pension funds, insurance funds, or family offices, ultra-high net worths, there's a much deeper access and variety of real estate strategies and deals that they can act on. So for instance, they'll be able to invest in development projects where they joint venture or partner with developers in developing residential apartments, townhouses, commercial buildings. Or they can go into value-add deals. So they go into lease-up opportunities, or for example, redevelopment and property repositioning. Next, they can also go into debt opportunities, so commercial mortgage-backed securities, mezzanine loans. And lastly, they get to invest in distressed deals and distressed assets. Now, with crisis, this COVID situation comes opportunities. In this climate, you would get quite a number of distressed deals, which the institutional investors would be able to access and invest into, but the individual investors would not be able to, right? So then that brings us to, for co-investments, co-investments would be able to bring about these benefits and gives users the access to all of these deals, which previously they would not be able to get onto. Right? Typically, real estate co-investment platforms will also be screening these deals, and after vetting through them and being assured that of the deal merits, or being assured or aware of the deal risk, and they'll put up these respective platforms for investments by the investors. Now, there's one more point that I want to make about this slide. So co-investing also brings about additional benefits, right? So it gives investors exposure across real estate sectors. It gives investors exposure across investment strategies. So by real estate sectors, I mean data centers, logistics, commercial properties, residential, industrial, and so on. Investment strategies, I mean, by core, value add, opportunistic type of strategies for real estate. And it also gives exposure across geographical markets easily. Right? Next slide. So on the whole, it gives a level of unparalleled access, right, for individual investors. Now, what we're doing here now in the next two slides is to compare co-investing with direct investing and with REITs. Now, the table shows the comparison across multiple variables, right, between co-investing and direct investing for this case. Variables range from capital requirements, diversification, all the way down to management expertise. Now, the assessment column on the far right shows the comparison and how co-investing stacks up with respect to direct investing. Now, I won't run through all the variables, and I'll just highlight a couple of pros and cons. So, like we earlier mentioned, co-investing gives us greater access and wider selection, right? So it also gives us, for when compared to direct investing, the investment capital requirement is smaller. There's also diversification benefits, and there's also lower risk. But last but not least, it gives us, a hassle-free user experience or hassle-free investment experience because there's little time and effort for the investor compared to direct investing. On the cons, co-investing there's lack of control, right? Because it's not fully owned by the investor as opposed to direct investing. And so you will give up some control there. Liquidity-wise, there's a typical lock-in period for the deals done through co-investing. Now, moving on, we compare co-investment with REITs. Now, again, I'll list out some pros and cons. Pros, so risk-wise, co-investing is shielded from stock market volatilities, where a REIT is exposed, right? So the REIT prices fluctuates with the market, even though the underlying assets may not be fluctuating. And yet another pro is that the investor gets to select, so there's a choice of asset. He gets to select the asset that he wishes to invest in. For REIT, there's no such choice. Typically, investors would buy into already pre-constructed portfolio if he chooses to invest in a REIT. For cons, liquidity, right? So co-investing has, again, lock-in period, so it's less liquid compared to REITs, whereas for the investment quantum, the co-investment takes a slightly larger investment quantum compared to the REITs. For REITs, you typically can go in at a couple of $1,000s, but for co-investments, typically 10,000 and up. Next slide. So in summary, here's listing out the value proposition that real estate co-investment platforms would bring the users, right? We earlier covered the greater access, better diversification, smaller quantum. Now, investors in real estate co-investment platforms also achieve higher investment returns compared to direct investing or compared to REITs. And this is through better access to real estate investment deals. Risk-wise, it is also lower because of the diversification benefits. It helps lower overall real estate portfolio risk. Further, the investors can also leverage on the platform's professional team in terms of deal sourcing or in terms of asset management. So that provides a hassle-free ownership, right? So let me recap for this whole section, right? Essentially, there is strong growth in real estate co-investment platforms, and USA is typically the forefront of technology and traction for real estate co-investment. And it is clear that the traction is strong, right? We also covered various factors why this field has grown, and we highlighted the gap in the market and the value proposition to these investors. Now, there's an evolution in the real estate investments industry, and we see this new way of real estate investment already starting to come to Asia for individual investors. Now, in the next sequence of slides, Keith will then elaborate more on the factors you should consider when choosing investment plans. Back to you, Keith.
Okay, thanks, Mao. Can we jump to the next slide? Thanks. Okay. All right. I'll touch upon the factors to consider when you choose an online real estate platform. Right. There are 4 parts to it I will cover today. Next slide, please. Right. The first is the team, the processes, the investment structure, and the level of transparency. All right. Next slide. Okay, on the team itself, this is very fundamental when you choose an online platform. I think, simply put, the team has to possess the right skill set, the knowledge, and experience. These three things, right? This includes market knowledge, financial know-hows, quantitative skills, analytical skills. But more importantly, when you choose an online platform and someone looking after your real estate, the team must have the transaction experience. What we mean by this, someone who has invested in a deal, managed the property successfully, and divested it successfully as well throughout the whole investment period. That's what we call whole investment life cycle. This is what we mean, right? So I have to say something about RealVantage. Next slide, please. Okay, for us at RealVantage, we have a combined experience of close to 100 years in real estate fund management, data science, and technology. On the real estate side, we have transacted, as a team, we have transacted in more than 10 billion real estate projects globally and across various sectors: residential, office, commercial, industrial. And throughout our careers, so we have taken on various fund management functions. For example, some of us are very strong in research, investment, of course, asset management, and portfolio management, right? And many of us have come from esteemed firms such as GIC, Barclays Banks, and ARA. Okay, next slide. The next section to highlight is process and procedures. Simply put, the platform should have a system in place to identify the right deals and to manage the deals, right? Next slide. Okay, so at RealVantage, this is how we do it. We have a very vigorous investment process, right? It starts with research, where we identify the right markets, the right type of assets. Next, we embark on what we call detailed underwriting, which entails a fair bit of financial modeling, scenario analysis, sensitivity analysis, before we actually go into due diligence. Now, due diligence is a whole new, it's a very important area to cover. Due diligence, usually there are 4 or 5 aspects to look after. It starts with the legal aspects, ensuring that your title is clean. Second is to go into technical bits, where you look at the property, you want to know that it's structurally sound, the mechanical and electrical systems are working fine, because all these have a material financial impact on your investment. So you need to know what you're getting yourself into. Next thing, financials. You have to go through the leases, pour through the leases, ensure the taxes are clearly calculated, and so on and so forth, right? Next is when we acquire an asset, after we have acquired an asset, we also put in place a detailed asset management strategy that sets out the yearly budget and the targets we need to hit. So what are these targets? The targets are really the numbers that was provided for our investors when they first invested into the deal. So that's the true north for us. Every year, we know what we need to achieve to get to that number, right? But fundamentally, when we look at the deal, the important consideration overriding all this is how are we going to make money out of this, right? The value creation part is fundamental, right? It has got to be crystal clear. Whether is it coming out for the income? So is the income secured? Is the value in acquisition price? Are we buying above market, below market, at a discount to market? Are rents reasonable? Is there scope to add value? Add value means you could be doing some renovations and trying to add value to it. Or simply, are we at the right time of the cycle, right time of the market cycle? So all these things we ask ourselves before we pull the trigger, right? And at the back of it, a very important aspect also is look at risks. These are important points to take note of. We look at market risks, demand, supply, stuff like that. We look at credit risk of the tenant. How strong is the tenant? Interest rate rates, where is it heading? Up, down? So these are a few key risk factors that we always look out for. Next one is is on investment structure. This is actually quite fundamental to what you're investing in. You need to know where your money is going to and what are you actually owning, right? So at RealVantage, our investment structure it's very clear. I just want to highlight two important considerations. One is all our deals, like I said, are structured in the form of special purpose vehicles, right? So what it means is this: you come into a shell company. There's nothing else in the company. You come in as a shareholder of that company, and that company owns only the real estate, nothing else, right? So what this means is you have a clear line of ownership, right? This is important, right? Second thing is the funds that's invested with us goes through a third-party fund custodian. So their job is to manage the bank account, safeguard the funds on behalf of the investors. Any withdrawals, any payments will be vetted by them before funds go out. So we don't have access to the funds per se, right? Next one, level of transparency and accountability. This aspect, it's a great challenge for fund managers, right? But at RealVantage, we believe in full transparency and disclosure. So all our deals, like you see, we go to our platform, we lay out clearly the investment structure, the risk factors, we do our cash flow modeling, we can look at our sensitivity, right down to the single dollar, how we calculate, how we think you're going to make money of it is there, right? And also the fees that we charge is going to be there. Now, every quarter, we also provide you with an update on how your investment is tracking versus the initial projection. Now, sometimes good news, fantastic. Sometimes bad news, right? If it's not performing up to par or not performing what we have said, so we have to also fully disclose this. Okay. Okay. So this is the last part of it. Let me conclude. Real estate, like I said, the whole concept of co-investing is a tried and proven concept. You do it at the institution level, informally at the retail level, but it's not structured properly. So that's where we come in and try to drive some structure and access, right? Technological advancements, like my partner Mao has mentioned, has enabled investors to partake in this, right? Next one, key benefits, Mao has mentioned about it, but just 3 points just to bear in mind. One is you have greater access to deals. Second, you come in with smaller quantums. And third is the diversification benefits, right? Exponential growth, as what you have heard, is like Mao mentioned, the US has caught on and grown tremendously. Now it's coming right down to Asia, and we think it's a fantastic alternative investment in real estate, right? Simply because it gives you better risk-adjusted returns. Right? Okay, the key factors like I mentioned earlier just a while ago, when you choose a platform, experience, credentials, experience, and so on and so forth. Okay, excellent. Now we have come to the end of it. We just pause for a couple of seconds and we jump straight in to the Q&A segment. Okay, so feel free to post your questions on the right. First question was for Mr. Lee Taylor. He would like the notes to be circulated. Yeah, we're happy to do that. In fact, this webinar, there will be a follow-on email to all investors, all our attendees, to thank them for coming online, and there'll be a link on this webinar in our platform as well. What I mean is on our website. Okay, next question is from Nareen. The question goes, tell us more about the legality of these platforms in Asia. Are laws evolved here like in the US? Yeah, I think that's a very good question, very good question. Those who are familiar with the Securities and Futures Act, there are licensing requirements for online platforms, investment platforms, crowdfunding platforms, right? So we are regulated under MES as well. So that's why for us, we can only accept investors who are considered accredited. That's the benchmark that MES sets for us, and we have to abide by that as well. Yes, in the US, I think the Jobs Act, they call it, it's definitely more advanced. They can also reach down to the retail level, as far as I know. Yes, I think Singapore itself has, among Asian countries, regulations-wise, MES has been at the forefront. The other countries are not as advanced. What is the next question? What is the minimum investment amount for your platform? Mao, you want to take this?
Sure, certainly. So in terms of minimum investment amount, it ranges from as low as 15,000 for our platform, and it varies from deal by deal basis. So the typical amounts would be phased out in the deal when we put up on the platform.
Okay, thanks, Mao. Next question: how to start investing in your platform? All right. Okay, there's an easy step-by-step process. We have both online methods and offline. Obviously, the first step is to create an account, and then the next step is to onboard you as an investor. So this essentially means that we need to do a number of checks on you. This is regulated by MES. They call it the Know Your Customer checks, similar to what the bank does, right? So after that is done, simply look at the opportunities that we have on the platform. Unfortunately, we don't have anything right now. We're still sourcing very hard. And then the next step is you decide what you want, and then you fund your account, and you just click on invest, right? It's a very seamless process. Okay, next question. What is the investment instrument for investors? And will individual investors hold the charge to the property? I think that's a very good question. Like I mentioned in my slide, the legal framework is something very important. You need to know what you are buying into. So the investment structure is quite simply you are a shareholder. So you subscribe to the shares of a company. And then from there, the company itself only owns the real estate. So the company has title to the asset. That's how it's structured. Okay. Next question from Mr. Tarun. How has the virus situation impacted on your ongoing projects? Also, has the situation led to new opportunities? Wow, that's a very, very tough question. But you see, for our investment projects, the ones that we have so far funded, there is a gestation period. Quite a number of them are value-add deals or opportunistic deals. They are in the development phases. So some of them are 2 years out, some of them are 3 years out, right? Or some of them even 1 year out, right? Fortunately, unfortunately, when we invested into Australia, and as what you are reading out in the news, Australia is relatively not as badly affected by this virus, which is a good thing for us. Some of the states have started to open up and allow people to get back to life, right? Bondi Beach in Sydney, for example, I heard it's going to open next week, right? And the number of cases there is now a trickle. For a country of 30 million, they only have like a handful of cases, less than 20. But on the flip side, unfortunately, the Australian dollar has taken a significant beating, right? So that, but our project itself is over investment period. So we have to sort of ride out this part of things, and we hope to emerge stronger on the other side. So there's about a bit of window for us between 1 to 2 years, some of them 2 to 3 years before we come out of it. Yeah, if we don't have anything that is income producing at this stage, I mean, regularly. Fortunately, we didn't invest in any retail projects because retailers are not paying rents at all. So we don't have anything of that nature at this stage. Now, definitely we see a lot of opportunities going forward now. It's a fantastic time to, because suddenly events, it changes the mood now. It's a buyer's market now. So you go in there and you can, previously when we put out an offer for an asset with a cap rate of 7%, no one will talk to us. Now when we put 7%, everyone starts to talk to you a bit more. So there is definitely it's a buyer's market now, and it's a good value hunting. On the distress side, as what Mao mentioned, we see a lot of opportunities as well. Where that's why it's important to be disciplined when you invest. Folks that have invested when markets were riding high and buying it at 4-5 cap rates, that's when now they really get to sweat. And your asset is not performing, not paying rents, and you're highly geared, you're under a lot of stress. Right? So we don't have assets of that nature, but these are the guys that we look for. That's where we can buy it cheap. Right? Okay, next question is... Sorry, I might have lost the questions. Just bear me a minute. The next question, would we get stress assets at attractive prices today? Yes, I think there would be. I mean, like I said, there are opportunities right there, especially assets that have owners that have highly geared themselves, 70%, 75%. And when your asset is not producing income, that's when it becomes quite stressful. And at some point, the banks will come after them, and that's where they have to get it out at a loss. Yeah, right. Next question from Patrick. What is the average returns? I think every deal, if you look onto our platform, we classify our deals into 3 different pockets, which starts from core right up the spectrum will be opportunistic. So core would be income producing assets, stable income, secured tenants. Those are what we call lower risk assets. And typically the returns will be about between 6.5% to 9% per annum. Up the spear, we call it opportunistic, where we take on development projects, for example. There's higher risk involved, and we aim for usually 20% for those assets. Okay, next question. Next question is it's a good question. Mao, you want to take this? The question goes, how would the fund works in terms of dividend payouts? How can individual investors exit from the fund? Any maturity for the fund?
Yep, sure, certainly. Thanks, Wang Yang, for your question. So how would the fund work in terms of dividend payout? So essentially, it depends on deal by deal again. So if it is a deal, a development project, wherein it's only at the bullet, it's only at the end of the project that you get a full amount, then so the full amount only comes at the end of it. So it's a bullet payment at the end. If there are, sorry, I can't be active. So if there is a dividend, so let's say every month there's rental income that comes in, we will take this amount, net off the expenses, and then distribute it back to the investors. Now this comes into the escrow account, and you will see it reflected in your digital account when you log in. Yeah. The other part of the question is any maturity for the fund. So again, it's on a deal basis, right? So which means that some deals there's a 3 years lock-in period. Some deals there's a 1 year lock-in or 5 year lock-in. So then it essentially is based off the maturity of that particular deal. Yeah. Okay. So Keith, you can take the next question.
Yeah, sure. Let me do it. Okay, we touch on the investment period. Okay. So our investment period ranges. It depends on the deal by deal, right? Some it could be a year, some it could be 2 years, some it could be 3 years, right? So there's no fixed. It depends on the deal itself, right? Okay. Next question is from Mr. Ong. He says, "Is there any guarantee?" The answer is no. There's no guarantee. It's not what investors like to hear, but it's the truth. I want to always, that's why we believe in full disclosure. When you come to a scheme where there is a guarantee, I'm always very skeptical. They give you schemes like, rental guarantee for 2 years or 3 years. Now, honestly, you ask yourself, why would somebody guarantee that for you, right? It's quite simple. It's all in the mathematics. You just take your money and return it back to you in that sense, they want to sell it at $100, but they sell it at $120 and take the $20 and distribute back to you for the next 2 years, and they call it guarantee, right? So there is schemes like that we are aware of, but the long and short is you go in and you understand the risk of an asset, and you invest in that asset if it befits your risk. Some of my investors are, they're very gung-ho. They like those high risks. Don't tell me anything about 7 to 9%. I want the 15 to 20% type. So, okay, fine. But I'll always tell them there's more risk involved. You could potentially lose your capital. For example, we have one project we're selling townhouses, right? I say there is a chance that the houses may not be sold in time, like what we say, it could be dragged out. So they need to recognize that risk and understand that, right? So it's important for people when they invest with us, they know what we're talking about and the risk involved. And we put it in a manner that they would understand that risk involved in what we're trying to do. Obviously, risk can be mitigated in certain ways. Obviously, the location of the asset plays a part. Are we hedging our interest rates and stuff like that? There are various ways to mitigate risk, right? Next question. For Mr. Teddy, are there any instances whereby investors would need to top up when, say, asset devalues, etc., if any? Oh, that's a very good question. Tough question. Now, the chances of that happening is remote, I would say, because it's how we structured the deal that's important. So, for example, if you buy an income-producing asset, that's why we need to take conservative leverage. I don't believe in going up to 75% loan-to-value ratio, because when you do that, the question is, can your income from the asset sustain the interest payments? And banks will impose a certain interest coverage ratio. You must be at least 2 times cover. I mean, your rentals must cover 2 times of the interest payment. And you can't. That's where the bank will come after you and ask you to top up. So that's why how we structure the deal, typically we do not leverage up too high. Maximum we go 60%. That's it, right? That's one. Second thing, we scrutinize the security of the income. And tenants that may not fully 100% pass our criteria, we ask for a higher security deposit. So when someone signs us a list, they need to put a deposit. We do ask for high deposits for those that don't fit our grade A criteria, right? So we ask for a longer security deposit. So the event bellies up, we got that income for the next 3 months or 6 months to help us tide through while we hustle and try to find our tenant to come in, right? So the long and short of the question, I wouldn't say no at all. There wasn't a need for us to top up, but the chances when we structure a deal is very remote, right? Okay. Okay, I think we just take one last question. We have sort of exceeded our time. Let me know if there's any last few questions before we end this session. Okay, from Erica, what countries do you think is good to invest in now? Okay, wow. That one, we'll leave it to, coincidentally, the next webinar, we'll be talking about market selection, where our colleague who's strong in that area will be speaking. Now, for me, as an investment guy, I go where I smell the most blood, put it this way. When people are affected the most, that's where you go and invest, because that's where values come off. That's where prices come off, right? So, of course, there's risk as well, right? Similarly, we have to adjust that with the risk. Right? So countries that we like to hunt right now are UK. UK has a lot of structural issues they're going through. Retail has taken a massive beating. That's one sector that we hunt quite closely. Second thing, obviously, with Brexit and all that, also they are going through very tough times. But I believe in the UK economy, to be honest. You cannot deny it's one of the major financial capitals of the world. And that doesn't disappear overnight. There are people still investing in UK real estate. So the fundamental of real estate is the security of tenure in terms of the laws are very clear. A lot of the assets in UK are freehold. That's what we like to look at. And also the land laws are very clear, right? And very transparent, right? Okay, next question. Last question, I'll just take this one. I just browsed your website. Do you guys do any currency hedging? Since yours, I saw only Australia and UK, right? At this point, we did not take any currency hedge. The thing to understand about currency hedging is it's actually quite expensive, right? And it takes quite a bit off your yield. So it depends. Typically, we will hedge interest rates. That's what we do. Currency, we don't take too much hedging unless necessary. Unless we are very sure that the currency is heading south, right? Then we hedge our bets, right? But typically we don't, right? So it's a risk. So it's a cost and returns calculation, right? We hedge on interest rates that cost us quite a bit, right? And we hedge on. Imagine of your capital structure, half of it you're hedging, another half you're hedging. Then the cost of it is quite hefty, so that takes a hit on your returns, right? Okay, I think that's great. I think we've come to the end of the segment. All right. I'd like to thank everybody for taking time to hear us out. It's great to have quite a strong number of participants. We will be conducting this quite regularly, and I find that it's a great way to reach out to our investors and to let them know how we run our platform, how we run our business, and hopefully you guys see value in us. All right. So I wish everybody well. Stay healthy and safe. All right. Thank you very much. Signing out.
Thank you, guys.
Okay.
Okay.
Cheers. Bye.
Bye now.